Hello, everybody. Welcome to the Thursday evening, daytime, morning, wherever you are. Financial Thing Thursday live stream. Glad you are here. Hope you are having a wonderful week. Of course, it is time to talk peer-to-peer lending this week. I am trying not to look too hard at the stock markets right now because it's a pretty miserable time to be a stock investor if you're looking at things on a short-term basis. Long-term, we all know if you stay the course, likely history says we'll be okay. But right now, things have been challenging. Things in the economy have been challenging. We'll talk about it a little bit. But this week is going to be mainly peer-to-peer lending based. If you do me a favor, please hit that thumbs up button. It only takes a second. Subscribe to the channel if you're not already subscribed. A couple of big announcements this week. If you go to the Financial Thing YouTube channel and you click right here on this live tab, you'll see the upcoming live streams, and you'll notice that we have a couple of guests coming up this month, in the month of March, beginning with, as promised, look at that. That's big. But there is me, and there is Mr. Roy Warren. We'll be joined by Roy, who is the managing director of Folk to Folk. That is happening on March the 23rd, so 2 Thursdays from now, not next Thursday. But is that the following Thursday? I don't know. 23rd of March, anyways. Roy Warren, along with COO, Chief Operations Officer Gary, will be here live doing a Q&A. And then, March 30th, the very next week, we have another guest. Mr. Robert Pascoe from Plend will be here to talk about peer-to-peer lending. So don't miss those two events that I think are going to be really great. We're going to sit down and have a chat with them, talk about peer-to-peer lending, talking about what's going on in the peer-to-peer lending space. And also, if you ever are trying to look at the old live streams, you want to go back and watch something over, you can click on that live tab right there, and that's going to show you all the different live streams, all the different guests going back as long as this channel has been going. How long has that been going? If we go all the way to the bottom, 3 years. 3 years now, so you can see me there in my crazy palm shirt back when I did it out of my living room. But yes, go check that out. And again, March 23rd, Folk to Folk. March 30th, very next Thursday, Robert from Plend, who's the founder of Plend. So I'm excited about that. I've been wanting to pick both of those companies' brains, Folk to Folk, which I believe right now may be the biggest UK peer-to-peer lending company. It's a little bit unorthodox as far as the company goes. I was definitely checking out their website and just to see what kind of products they offer. They do offer more of a high net worth product on the investing side. I think you have to put in let's have a look to 20,000 pounds is the minimum. So definitely high net worth individuals that they're targeting, with an interest rate from 7.5% to 9.5% per year, which is paid monthly. Pretty big entry point investment, but you know, everybody has different abilities when it comes to financial investing. So we try to do not only the higher end, but also the lower end. So we're going to talk to Roy and Gary about that. And then, of course, Plend, which currently we are not able to enter as investors. They are continuing to do things on a beta test level. But I expect, hopefully soon, we should be able to invest through their loans. And they just really seem to be growing from strength to strength at the moment, so I'm excited to have a catch up with Rob. Met him in London a couple of years ago. Got to have a sit down, sort of talk about Plen's business. And I really like what they're doing over there. I think they are cornering a market which is greatly underserved. And the way they're using open banking to really look at people's credit situations objectively to provide high quality lending and also to receive high quality borrowers is very innovative, the way they're using the technology side to do that. So we will talk to Rob more about what's going on over at Plen on March 30th and when we can expect as investors to be able to be a part of that and to be able to invest through Plen's loans. So there you go. I've been promising more guests, and yes, that's what I do for you guys. I deliver. So I hope you will tune in to those events. Quick hello to everybody on the stream. I know the weather is very cold in the UK at the moment. Snow, miserable conditions. Sorry to hear that. It's just part of living in the UK. Invest22 is back from snowy London. David Dawson is here. John Day, light snow in Nottingham. We even have snow in Toronto. Mr. Jam Roberts is here. Welcome. Colin Perry, Wintry Peak District. Paul Bagworth is here in Kenilworth. Of course, Alan Toombs in Basingstoke. Mike Powell. Stephen E. from Macclesfield. I am buffering, of course. I don't know what's going on with the buffering. I still haven't been able to figure that out, but I think a call to the internet company is going to be what's needed. So apologies if I am buffering. Not much I can do about it right now. Thank you for the nice comments on the hair. Accrington is snowing in Accrington. That's a shame. Jimbo Naughty is drowning in Cambridge, and Robert Pates is here, usually in Greece, but now in Hornchurch. So glad you guys are here. Again, hit that thumbs up if you can. It's very helpful to let other people know that the stream is happening right now so we can inform other people and give them the knowledge that they really need to have when they are potentially becoming investors. You can see also Harley the hound dog is taking a nap there in the corner. I was thinking about setting up a Harley cam. So for dog lovers, they could kind of check out what she's doing, which is mainly sleeping. But tell me what you think about that. You think it's a good idea? You think we should have a Harley cam? I do. We'll see. Anyway, let's get right into it. Let's talk about what is going on. Here we go. We'll start out with quite fittingly. Oh, hold on. Let's turn that off. Some people know exactly when to call. First story, folk to folk. Quite fittingly, there he is, Mr. Roy Warren, looking very serious. He is warning of dangerous city funding. Now, we talk a lot, and we have been talking a lot over the last few months about institutions who have been getting involved with peer-to-peer lending and taking the retail people out. So taking us out with big banking money. And Roy Warren from Folk to Folk, who will be here on March 23rd, he has reiterated that Folk to Folk is committed to individual investors and has warned of the dangers of relying on institutional funding. The secured business lending platform is now the largest peer-to-peer lender in the UK, with a loan book nearing £600 million. And I got to tell you, Folk to Folk has really been off my radar. I did try to sign up for an account. It's definitely a different sign-up process than the other peer-to-peer lenders. It seems to be more manually operated, so I haven't as yet been able to get an account to go into the back end and kind of look at what's going on the platform. I'm presuming there's some kind of a back end there, but since they target more high net worth, maybe their system is different. I don't invest through them, so can't speak on that. But Mr. Warren said that Folk to Folk will remain loyal to its its existing customer base despite the challenges of strict regulation. Last month we turned 10 years old. Says Roy, we have gotten to where we are today through our loyal high net worth investors. That's where our loyalty lies. He also said it's easy to throw it away and go to institutional funding that we've seen, obviously, other peer-to-peer lending companies do. It would be an easy life, especially with increased regulation around retail and fear of further constraints. But why should we deprive high net worth individuals of choice? That's the key thing. He also added that running into the arms of an institutional investor, that's really so poetic, isn't it? Running into the arms of the institutions. Yeah, I like that. Running into the arms of an institutional investor is a dangerous place to be in, as you can end up losing control of your business. Folk to Folk has had discussions about large institutional funding lines, but felt that those companies would end up running the platforms. I think that that's something we've kind of addressed too and talked about. That when you do sell your soul to the institutions, which I think when you take institutional funding, you really are selling your business soul. You don't have a lot of control, I would imagine, as especially a smaller business if you have a funding line of high amounts. So Roy addresses that issue. Let's talk about Lendy. Lendy's administration announced a second round of distributions. If you have not logged into your Lendy account recently, I would advise logging in. You might find that you have a few pounds, hopefully more, sitting in your account that you can withdraw right now. I just did it myself. Lendy Administrator RSM has announced a second round of interim distributions for loans with a balance higher than 100 grand. They are now in a position to process second interim distributions for loans, Development Finance Loan 1, PBL 103, 163, and 164. So if you're invested in those loans, you're going to get some form of a payout. I was personally in DFL 01, the original 01 that I thought looked good at the time. Obviously, I was incorrect about that. RSM said that in line with the agreement with the relevant stakeholders at this stage, it will not process further interim distributions on loans where the balance is less than 100,000, as it would not be cost effective for the investors. Further distributions have been promised once a cost protocol has been agreed by courts, a draft form which is currently waiting for court approval. Interim distributions have processed approximately 15,168,000. So, problem is that RSM's fees have been crazy, millions of pounds. I think up to 5 million at the moment. Really, not a very good situation there. But at least, we're getting some money back. Crowd Property has set out 3-year growth strategy. So as we know, we've had Mike Bristow on this channel several times, talking to him about Crowd Property and how things are going, and they definitely want to grow over there. So they're making a pathway to doing that using Seeders fundraising, which is going to be coming up soon. Which, too, if you want to get shares in Crowd Property, you're going to be able to do that through Seeders. Personally, not something I will be doing, but again, you're open to taking a look at that if you think it's something you want to do. They're looking to build a truly scalable development lender. That they will be taking a cautious approach to growth due to the economic climate. The fundraise on Seeders is to ensure that their 3-year growth strategy is fully funded with equity capital raised alongside reinvestment of profits and cash flows from the operating business and working capital optimization. So basically, in layman's terms, is saying we have this growth strategy that we want to play out over 3 years to really grow Crowd Property, and we want to make sure that we have enough cash to be able to do that. Revenue at Crowd Property has grown by 41%, and they're expecting a third year of profit despite significant ongoing investments to build infrastructure for future scalability. In the last 12 months, Crowd Property has grown development facilities by 51% despite a slow fourth quarter of 2022. So Crowd Property, again, they are definitely growing in the right direction. That is what we'd like to see. That's what we want to see. And yeah, as you know, when a property platform like that, peer-to-peer lender, wants to grow, it's important to have that infrastructure to grow. You don't want any of these companies trying to bite off more than they can chew, because financially that puts them in a really bad position. So the fact that they are doing the Seeders fundraising, I think, is a positive thing, despite me not really being a fan of getting institutional shares in that manner. But I understand why they do it, and I don't necessarily think it's a bad thing. I see Mike has written that the Seeders campaign is now open. Okay, so there you go. You can get the shares in Cedar for Crowd Property right now if you decide you want to. Now, the folk-to-folk story. When I first read this, I thought, FIBA, huh? Folk-to-folk joins FIBA as a lending partner. But we're not talking about FIBA, the football association. We're talking about the Financial Intermediary and Broker Association. So they're looking to develop new relationships with loan brokers and broadening understanding of secured lending option. Now, this is a play to really educate loan brokers of the existence of peer-to-peer lending, because I think, we all know this is still a very niche lending sector, and the more that peer-to-peer lending companies like folk-to-folk can reach lending brokers, it means more loans for you as an investor, and it's generally a good sign. So they are looking to develop those relationships by joining the FIBA Association. It says our lending partners are carefully selected to offer our members and their clients choices across the broad range of solutions that will engender good customer outcomes. That's what FIBA Executive Chairman Adam Tyler says. I don't even know what engender means, but I am but a simple man. He says the addition of folk-to-folk with their energizing approach to supporting business across the region will be well received by the membership and offers more choice for brokers. I've been impressed with their sensible, no-nonsense approach to products and service provisions, and the team at FIBA looks forward to working with the team in support of our members. Roy Warren also says, I believe our strong relationship focus coupled with simplicity, speed, and straightforward nature of folk-to-folk loans have all been instrumental in our successful broker partnerships to date. They're looking forward to working closely with FIBA members to help broaden the understanding of secured lending options available. And I guess there is going to be an annual conference at the Manchester Central on the 21st of March where folk-to-folk will be there representing. Good thing. Consumer credit is getting cheaper as interest rates fall in 2023. You know what? We are going to talk about that a little bit later. There's an article that says how Cufflink investors drive changes at the platform. So a lot of the times I think that investors don't really have that much influence in the way that property platforms, and not just property platforms, peer-to-peer lending platforms change and introduce new products. I always have a feeling that we as investors don't really speak up very much, and a lot of the times the platforms are kind of making their own decisions. But this article seems to say that Cufflink appreciates a lot of investor feedback, and the way that they change their products may be due to that investor feedback. So I definitely would encourage you, if you do invest, you have things that you would like to see change, get in contact with the companies, send them an email, because apparently it does make a difference. Cufflink has refreshed its range of investor products and services following feedback from its user base in a collaborative approach which demonstrates the platform's level of engagement. And I can definitely appreciate that. I've had a pretty close relationship with Cufflink over the years, and they do ask me for that feedback, which I do give them freely. The platform has already raised its investors' interest rates, but it's now planning a rollout of other changes following a series of conversations with users. Head of Products Paul Orger says we are doing a refresh on our investor products. We're trying to stay in tune with what's going on in the marketplace with other lenders and in the generic marketplace. We're very grateful for our investors' confidence in us. The majority of Cufflink's investor feedback has revolved around interest rates. I mean, who doesn't want more interest? I think that's probably number one on most people's lists of wants and needs. They just want to make more money, make more interest. Interest rates are what investors speak about, says Paul. We're looking to make our rates as competitive as possible, while also explaining to investors it's still a business, so by increasing their rates, we could be working on reduced margins. It's a balancing act between what we pay investors and ensuring that our rates to borrowers are competitive. This is a very, very difficult balance that peer-to-peer lending companies have to take on. They have to make sure that you as an investor are happy by being paid enough interest, and the borrowers are happy by not paying too much interest. So they're constantly balancing things out to keep everybody happy on both sides. It's not a job I would want to have. Furthermore, the platform is expanding its outreach in key demographics to kids in their late teens to early 20s at the moment. So they're trying to bring in that younger crowd into peer-to-peer lending. Narinder, who's the CEO, says he doesn't mind hearing negative feedback. It allows him to hear what investors really think. We do listen, he says. I want to make those changes. We don't have the right solutions in-house all the time, but we can bring them in. They're looking for a more collaborative approach. For example, recently, several investors told Cufflink they wanted to see joint accounts added to the platform. It's something that Cufflink is considering. Investors are also interested in using their peer-to-peer funds as part of their pension plan. That inspired Cufflink to offer new ways to manage pension plans on the platform, and they're already offering SIPs, which they're not actively marketing, but that could be a good market to go into. We're looking in whether to take institutional pension money, which is a whole different board game. So a lot of things that they're looking into at the moment. Not sure exactly which of those things are going to be implemented or not. Probably bring Narinder on at some point from Cufflink and kind of have a chat through that. One thing I was thinking about this week, because I was reading, these administration updates that come through into my inbox quite often. Glendy had the house crowd this week. And I started to think about what could we do differently to avoid the mistakes of the past. And I had a couple of emails this week about people that were really down on themselves, upset about having invested into peer-to-peer companies that have failed. I also got summoned to appear as a witness in the collateral court case where the Curry brothers have been accused of fraudulent activities that have really harmed investors. And what I replied to these people that emailed me was that sometimes you can do the most due diligence. You can listen to your gut feeling. You can do background checks on the people that are running the company. You can look over the financials, but you're not always going to get it right. There are going to be times where you make investments in life that just don't pan out. I think that's just part of being an investor. The luckiest investors in the world, maybe they get it right 100% of the time. I know I haven't. And one thing that I've become comfortable with and accepted is that I'm going to make mistakes investing. I'm not going to have a 100% track record. It's just not going to happen. I had to be comfortable with these peer-to-peer bumps in the road where I invested in several peer-to-peer lending platforms that just didn't work out. Whether it be through fraudulent activities, bad management, gross mismanagement, poor investments on my part, picking out bad loans. I had to become accepting of that. And in every sector of finance, we expose ourselves to a possible failure, whether it be peer-to-peer lending, Lendy, Collateral, Funding Secure, Wellesley, the House Crowd. There's a list of them. Whether it be picking out stocks, some stocks go to zero. Companies get mismanaged. Companies go bankrupt. Even going so far as putting money in bank accounts. That doesn't always end well. Most of the time it's okay, but there are stories and situations out there where banks have gone bankrupt or things have happened within banking. So to be comfortable with saying that if I'm going to take a risk to invest, I also have to understand that there's also some downside of a possibility that things are not going to work out. Now, hopefully those losses are not huge losses. That's what we try to avoid, is the big hits, like the big drawdowns. And that usually comes from being too greedy. I mean, in my own case, it's always been going after things in too big of a chunk to get that big payoff. That's where I've taken the hits. I've seen it in peer-to-peer and I've seen it in stocks. There was a time when I was investing through MoneyThing kind of recklessly. This was very early on in my peer-to-peer lending life. They used to have these aggregated pawn shop, did I say that right? PAWN, YouTube, pawn shop loans. And I was so heavily invested in those things. They were paying 12% a year. You could sell them on the secondary market. It seemed like just such an easy thing. And I realized one day I woke up and I was looking at my account going, God, if something happens, I wasn't even thinking about something happening in the money thing. I was thinking about something happening to that company that was taking these loans on. I thought, if something happens, I'm so overly exposed. I'm really going to get hit. And I thought about it. I kind of have this 24-hour rule that I wait 24 hours before I make any financial decision. And I waited 24 hours and I came back to it and I said, I'm just going to sell them all. And I sold them all. I was lucky, because that would have been pretty bad financial hit. But I had to realize, I was misinvested, didn't have correct diversification, and things didn't, go as badly as they could have done. I've still got money wrapped up in the money thing, not as much as I had, but it's still there. I had to be comfortable and learn to accept that those things are going to happen, right? And that's what I said to the couple of people that emailed me last week about how they were really depressed about the money that they had in peer-to-peer lending. Actually, one of them was a stock investor and had lost some money in the stock market. And I just said, look, that's part of the deal. That's part of the risk that you take when you invest. It's not always going to work out. But the problem is, if you don't do it, you become so gun-shy, you don't really give yourself a chance to succeed. And we have a lot of economic headwinds that are facing us right now, that are blowing at us, stopping us from moving forward. We have possible interest rate rises that I expect will come in the U.S. later on this month. We're talking about the Fed possibly increasing interest rates again. Small chance of another 0.5% increase, probably a 0.25% increase, which will then waterfall down, I expect, to the UK, where interest rates will go up again, trying to battle this inflation. But you just have to be okay with the choices that you make when it comes to investing. You don't want to be thinking, I'm such a dummy, I'm such an idiot, I've lost money in this investment. poor me. You just have to accept those decisions and be okay with them. There's this article on Jean Galea's website just talking about Lendy. Look at they're not doing very well on the Trustpilot reviews, quite understandably. But he's talking about Lendy here and the situation that happened. He also listed my video here and said, you know, he didn't know about this YouTube interview. By the way, if you haven't seen it, I don't tend to watch this video because it makes me mad. You know, look at Liam right there. He looks like he's about to punch Paul in the head. But yeah, this makes me upset to watch this. It's still up on the channel. I thought about deleting it because do I want to give this guy any face time now? No, not really. But I think also it's important to have these things stay up there for people to look at. And unfortunately, it doesn't tell the real truth of what happened at Lendy and what was really going on. But Lendy was just unfortunately part of an investment mistake that I think a lot of people made. They put a lot of trust into a young financial sector, and a lot of times when it comes to finance, I think we give more trust to people running finance companies than we would just regular people. That's definitely a mistake that I made, right? But remember, there also is a lot of situations that you can get into where you think you're safe. This is, one example is Iceland back in 2000, I think it was 2008. It took about the Icelandic bank crashes that happened. Icelandic people had sort of come into wealth, and there was a lot of banks over there that were purporting to be something that they weren't. And this was a bank. I mean, a lot of people trust putting money in the bank. They do. They think that banks are safe, nothing bad can happen. And I think this is important for us to remember that no matter what sector that we're investing in, things can happen. So the first to go was Landsbanki, which is, I think, a terrible name for a bank. And it served just 350,000 Icelandic people. They had a bad bank balance sheet. They collapsed in 2008. Two of other Iceland banks followed soon after. The banks made up most of the value of the small Icelandic stock market, which most Icelandic people were invested in, either personally or through government pension plans. Nearly the entire country's retirement savings were wiped out. Iceland really had a difficult time. Then we also had the Cyprus Bank disaster, where what happened over there, the government had to put a levy of a tax of 6.75% from insured deposits. So everybody lost 6.5% of their bank balances and 9.9% of any uninsured balances above 100,000 euros, right? So those people, I would say people that store money in a bank are probably the most conservative people in the world. And now those people who were a part of the Cypriot issue and the Icelandic bank issues learned a very hard lesson that really, at the end of the day, nothing is really 100% safe. And if you make a choice to put your money somewhere into an investment, there is always a risk that things are going to go wrong. We had the Enron situation, which was considered the darling of Wall Street, that collapsed in 2001. It was considered the darling of Wall Street only for 5 years, from 1996 to 2001. yeah, and it happens in the stock market, it happens in the banking, it happens in peer-to-peer lending. And we just have to be okay with, just accepting of the risks that we take when we're investing, and know that if things don't go our way, that hopefully it's not a catastrophic loss financially. If it is a catastrophic loss, we've probably been doing something wrong, right? If we put too much money into any one given thing, even bank accounts, you could say having a lot of money sitting in a bank account, even if there was a 5% risk that a bank could go belly up or a government can go belly up, then probably taking too much risk. But you have to be okay with that. You have to accept that that is just part of what comes along with investment management and money management. So I was reading some of the house crowd updates recently, and there was a couple of things in the administration update that I found that was interesting. And some of these documents are really big. They could be 40, 50 pages long or more. A lot of people don't want to read the fine print and all the things that go into them because they can be kind of dry and stuffy, but sometimes I'll take a read through. The joint administrators in the house crowd situation anticipate that the duration of the insolvency process and realization of assets will have to continue for a longer period than anticipated, with a projected conclusion date of February 2025, which I think is nonsense, and that's not going to be wrapped up by 2025. Could go on for another 5 years. But given the forecast increase in the costs for the reasons said above, the joint administrators intend to return to court to seek an increase in current cost recovery basis from 11% to 23%. So they want to double what they're going to ask the courts for their costs. Do you think investors are going to be happy with that? I think not. I think there's going to be a big uproar for people who have actually read this. Also, we'll look at here talking about costs. As detailed in the receipts and payments, the joint administrators have drawn the sums of $397,000 and $656,000 respectively from bridging and development loan recoveries to discharge third-party costs of the administration estate, as well as the joint administration's remuneration. So we're talking about £1 million in fees that now they want to increase to 23% from 11%. So we see these fees likely up, probably going to double. As of February the 21st, 2023, a total of $861,000, excluding a VAT, of fees have been drawn in respect of the joint administrator's remuneration. And this is just off of one of the three companies within the house crowd. Sorry to be depressing, but you know what? I just read what's going on and let you guys know about it, because I think you need to know that when a company has administration going on, or even in their agreements, if the company ever goes out of business, you need to know what's inside of these agreements, because these types of things do happen. Here was another thing that made me laugh. There's a property management fee, as previously reported. House Crowd Property Management, or HCPM, continues to provide the services set out in its property management agreement with the HCP SPV. So we still have the house crowd managing the properties, even though they've gone bankrupt and don't seem capable of running a business. But for the above services, they're entitled to 10% of the annual income for collection, or the same 25% of the profit share of rental income. Due to insufficient funds, these costs have not been taken and have accrued over time. So these amounts are accruing over time that House Crowd wants to collect on eventually. And on the balance sheet, this is for House Crowd Property Management Liquid Limited, which is in administration. The House Crowd Limited is listed as a unsecured creditor to the tune of £552,597. So they are listed on there as a unsecured creditor. Now, I haven't studied the house crowd completely. I'll be honest with you and transparent. This is a lot to take in, keeping up with all of these different companies, and administration is going to be challenging. I don't know what necessarily this means on the balance sheet, if it means that eventually the house crowd will try to attempt to get some of this money as a unsecured creditor. I hope the courts would step in and say, why don't we pay the investors first? But you never know. What else do we have here? This was a Blend Network update. I always like to read these. I think they're pretty interesting. Blend says, and this is a February update, or March update, sentiment is becoming more balanced, but lenders are still very cautious. House prices were down by 1% year on year in February, the first annual decline since 2020 and the weakest since November 2012. I fully expect that you're going to see a very weak housing market as these interest rates start to climb. There will be opportunities, I think, within the housing market, but I think you're going to see less buyers at these higher interest rates. I mean, it makes sense, right? If you're paying twice as much for a mortgage as you were a year ago, most people are just not going to be able to afford it. Compared to their peak last August, the price of the UK average home is now down by £16,000. And also here, very important, net mortgage lending to individuals decreased to $2.5 billion from $3.1 billion. Now, $2.5 billion of lending sounds like a lot, but it's a pretty significant decrease. Mortgage approvals fell for a fifth consecutive month to 39,600. So you can see here on this graph, this is the year-on-year house price raises up through the pandemic. Boom, some ridiculous rises, and then this complete drop-off. So pay attention to this. It's important economically. If you if you are interested in the house market and the housing market, which I think everybody should be paying attention, because it is a pillar of the economic financial world, and especially in the UK. Sign up for the Blend Network's email list, and you'll get this report every month. I think it's a really good report. They do some good studies. The shortcut smart statistics, land value corrections have gone down by 9.2% year on year from last year. There's also a declining supply predicted of up to 122,000 homes per year because of political and legislative decisions. We see this minus 1.1%. Price decrease versus February of 2022. So very important stuff to pay attention to. And let's do a quick Trading 212 portfolio look. It's painful. I was hoping for better things this week, but that is not happening so far. We ended down to 16,319 pounds, dropped a couple of £100 since we looked at this last week. Calera has been stabbing me in the throat. They did a 2-for-7 stock split because the price was decreasing. They wanted to keep it live on the New York Stock Exchange, which you have to have a minimum value of a $1 a share to do that. So my Calera shares have been cut to a little bit less than 1,000 now. Had a lot more than that, but the value would technically remain the same. It's just now more expensive per share, 2.32. We have lost 42% of value in 1 month. Just goes to show you, stock trading is not for the weak of hearted, and mistakes get made. This one has not been a good one. Nothing is looking particularly good except for Flex in the green, 41%, but everything else is looking weak, and I think that generally the stock market is just looking extremely shaky and volatile. I would not be surprised to keep on seeing these prices go negative. Would the right move to be just to sell the portfolio, take a tax hit, and move on? Maybe. Keeping an eye on it may do that, but I don't know if it's time to pull the cord on this Calera investment yet. It seems to happen that when I make a decision like that, the next day everything goes back up 25%. So we are being cautious. One other thing, too, that came up in the news this week that I thought was pretty interesting was about cars. Because I've been doing a little bit of car shopping myself, and I've noticed how expensive cars have gotten. The car that I bought in 2017 is worth about 10% less than it was back in 2017 today. And I'm wondering how people are affording these increases in cost. And they're taking loans. I know they're taking car payment. They're taking less of a car payment for longer loan terms. Here in the U.S., you can get, I think, up to 86-month car loans now, which is ridiculous. I always say to people, if you are not in a good financial position, you shouldn't be taking on debt like that with car loans, because that can really bring you down big time financially. It's one of the biggest nooses around people's necks. I wanted to look at this article. It said, what is the average car payment in the UK? The car expert estimates that people are spending an average of £218. That is just running petrol, diesel, not including purchase costs or finance costs. So how much does a car cost per month? The average cost of car insurance is about £40 a month. I'm estimating that an average car payment in the UK is probably around £300. So we're talking about probably right around £750 a month for your average person to own a car. I found this interesting graph, which was, I think it was on topgear.com. It said the cost of a lifetime of driving in 5 countries, right? So United States at the highest, because if you live in the US, I can tell you that if you walk into a car dealership, they will just throw a brand new car at you. You pretty much have to have the worst credit in the world and no job not to be able to get qualified for a car loan, because they love to hand out car loans here in the US. So this is what the average person spends through their lifetime on cars in the US. £591,000. This is in pounds. It's a lot more in dollars. I'll enlarge that so you can see it. Yearly cost £9,634 a year. So that is about £700. In the UK, a little bit less, but still pretty high. £437,627 over a lifetime. How much you're going to spend on cars? Yearly cost of about £7,294, about 500 and something pounds a month. And this, the reason I'm talking about this is this economic situation that's happening with cars, it's happening with mortgages, and it's happening with student loans for people borrowing money to go to university. This to me all seems like a perfect storm of unaffordability, because wages are not going up. Wages are not going up by 20% a year. Wages are staying pretty stagnant. Most people, maybe they're getting a 2 or 3% raise. But wages are not going up, but these things are becoming less and less affordable. Eventually, these payment problems are going to be a big, huge problem. And I'm surprised it already hasn't happened. Your average person paying £700 in car costs and loans, it's pretty unaffordable. If you're making average salaries of £30,000 a year, you're paying out £700 just for a car. You're not going to be able to do it. And then you add housing expenses, the increasing cost of energy. What I expect to see is eventually this just all coming home to roost. And I'm really surprised it has not happened yet. What happens when it comes home to roost is big problems in the stock market and just probably some kind of economic meltdown. I hope it doesn't happen. I hope for the best. But these numbers, they show the real truth about the things that we can spend money on that we don't necessarily really need to have. I mean, of course, people need cars, they need transport, unless you live in a major city with really good public transportation. But for the most part, I think it's wise to be very thrifty when you're spending money on things like cars. If you can pay cash for it, you probably should be doing that. If you can't, now at these interest rates, it doesn't really make sense to finance less the car. I mean, I always tell people car loans are bad ideas to begin with. Maybe if you can get some kind of miracle 0% deal on a car, maybe that's worth it. There's always downsides. I mean, car dealerships going to make money on you one way or another. What you think is a good deal is usually not. But yes, this will all come home to roost. And I think it's going to come home to roost for people in different countries. It's a shame. People are going to get hurt. But the best thing you can do is prepare yourself, really kind of keep an eye on what's going on. Hopefully we'll be all right. Anyway, sorry about the buffering. I understand the buffering is around. Yeah, car leasing does make sense to some degrees, but you got to be careful of those leases because they're complicated. If you ever read a car lease agreement, you ever try to negotiate a car lease, you're never going to get the best situation when you're leasing cars, so be careful out there. Anyway, I'm going to get out of here because I've been waffling on for way too long. Apologies about the buffering. I'm going to try to get that sorted out. But remember, 23rd of March, folk to folk. 30th of March, planned live back here with me, the dog, wherever she is back there, taking a nap. And I appreciate every single one of you for joining. I hope you enjoyed the stream this week. Carmageddon. I like that. That's a good one, Darren. But I'll see you next week. Have a wonderful weekend, everybody. Enjoy the weekend. Hopefully it doesn't snow too much. And if it does, make a snowman. There's nothing better than that. Take care of yourselves. And I'll see you next time. Bye.